George of the jungle, strong as he can be.
Okay, we're back. This again is going to be part 3 of how to create leverage on investment property and not be a landlord using seller finance techniques. So this is part 3 on this, and we're going to do a little bit of a deep dive into the numbers here. So I might talk slower and illustrate some numbers on this because I want you to understand how powerful this is and what we're going to show. Again, if you have not watched part 1 and part 2, this is not going to make any sense to you. Please stop, rewind, go look on my YouTube channel and find part 1 and part 2 because this is just going to sail right over your head if you don't get this. So again, we are now putting ourselves into a position where we are basically an investor, and what I call it is that you're really just being a bank. Okay, so think about if you buy your car and you have a loan on your car, and the tires need to be changed, or you need to replace the battery or something like that. Do you call the bank and ask them to, you know what, I'm having some problems with my car, could you guys please fix my car for me? And they're going, what, Mr. Anderson? I mean, we're a bank, okay? All we do is collect payments and make interest, okay? So what you're doing is you are basically becoming the bank. And how do banks make money? I mean, go downtown in any big city. What are the biggest buildings, okay? They borrow money at one interest rate and they lend it back out at a higher interest rate. So look what you've done here. You have borrowed money at 4.25, borrowed $400,000, and you're lending out $495 at 6.75. So let's look at the numbers here, and I want you to understand what kind of rates of return that we're talking about with this. So again, why is the tenant willing to pay, or the seller finance buyer, why are they willing to pay a higher price? Why are they willing to pay a higher payment? A, because they have a 30-year contract to be able to purchase that home. And if nothing ever changes for them with their credit, their income, their immigration status, or whatever it is on there, if it takes them 30 years and they pay that house off, when it's paid off, it's their house. They get the title to the house after they've paid off the contract, okay? So they're willing to do that, and also that higher payment is not $3,000 a month like rent that goes to nothing. This is a regular amortizing payment, so there's a portion of every payment on this that is going to principal. In fact, we're going to show another calculation on here, but they're actually putting about $450 a month is going as a principal reduction. So again, their equity position is increasing in this, and they understand that and they're willing to do it. So how does this affect the numbers? So instead of having about $1,000 a month of cash flow on a typical rental, okay, which you really wouldn't have that much because this payment doesn't include taxes and insurance, okay, and you're probably going to be lucky to get the tenant to pay the utilities and stay current on that. But this buyer is more than happy to pay the taxes and insurance on top of that. So I'm just going to show the principal and interest payment here versus the principal and interest payment here. I've got a delta, or a difference, of $1,242 per month. This is your cash flow. This is the money that's coming into you every month, okay? And at the end of a year, you've collected $14,904, okay? Now, here's the difference on this. Not only are you a bank, okay? In other words, you're not dealing with the broken water heater, you're not dealing with the landscaping issues and stuff like that, okay? What are the chances of somebody not making their payment on a home that they've put $55,000 of their money down? I've never had a problem with it, and I've done 9 of these transactions in the last 3 years. I've never had anybody make their payment past the 8th day of the month. So they're very motivated, and they're very responsible because this is their home, okay? So you've got $14,904 is your cash flow, but what's your investment? You put out 100, you got back 55. So your total investment in this property is only $45,000. Your internal rate of return on this one, sorry, I got to look at my cheat sheet. Okay, 33. 33% rate of return, which, yes, 33% is more than 12%, okay? And again, we said that that 12%, that's a vacuum, okay? This is a pretty reliable number that you're going to generate on this. So if you had $100,000 to put down on a property, look at the other side of this thing here. Not only do you still get back $55,000, if you can go scrape up another 50 grand again, guess what? You can buy 2 properties because you've only got 45 grand here. Now, you cannot use this money that's on deposit as part of your down payment, okay? So I just want to clarify that. You don't own the house yet. You don't own their option money until you own the house. So once you close on the house, okay, you have the title and you own it. Now you go back and do a second closing, and this is a seller finance transaction done at a title company, done with title insurance, a HUD-1 settlement statement. All the legal documents are there, and this is a real transaction that grants equitable interest. Okay, they have an ownership interest in this home, and as such, they are going to treat the home much differently than someone who has renter's mentality. So 33.12% rate of return, but wait, there's more. Okay, so I hate to do that because we're going to add some other elements to this in part 4 when we get into that one. So, in fact, you know what? I think I'm going to just let this simmer in and then go into a tax calculation and then also an amortization calculation and show you how that does it. And that'll probably be the final part of this rental property, seller finance, leveraged presentation that we want to make here.